In this video, we will discuss strategies to outperform the S&P 500 using sector funds with a focus on the information technology, communication services, energy, and utility sectors. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. As of July of 2022, the S&P 500 sector weightings were as shown, with by far the dominant sector being information technology at around 28%, followed by healthcare at 14%, consumer discretionary at 11.5%, financials at 11.6%, on down with the other GICS sectors of communication services, industrials, consumer staples, energy, utilities, real estate, and materials being in lower weightings. This was the weighting of the S&P 500 then, split into its 11 different sectors, but this weighting has varied drastically from time to time, and even within a one-year period. If we go back into distant history, early 1800s, we find that when the first people who started the New York Stock Exchange met under a buttonwood tree, the dominant sector was finance. By the mid-1800s, that had been supplanted by the railroad industry and transports, and then gradually with the Industrial Revolution, you had a movement into a variety of different sectors. You can also see on this graph in the 1930s, there was a major dislocation associated with the Great Depression and the nationalization of some sectors and certainly the bankruptcies of others. And then gradually in modern times, of course, IT has become important. Before that, energy was extremely important. And at various times, other areas like materials have been of a huge importance. Here is a similar graph, the sector share of the S&P 500 net income since 1975, which runs up to around 2022. Note that the net income in each sector has also varied drastically, with the energy bubble in the early 80s, the net income share being up to 27% in energy. During the tech bubble, tech got at 14%, and of course the percentage of stocks on a market cap basis in tech was much higher then due to speculation of future growth rate and just enthusiasm with the sector. That of course burst, and then the sector percentages going to tech went down drastically. And we can also see the financials bubble associated with the housing bubble that burst around 2008, at which time the income in the financial services industry basically went to zero. Looking at this, we can see that it's probably not a good idea to always invest in whatever sector is doing the best. This is further demonstrated by this graph showing S&P 500 sector performance from 2007 until 2021. And you will note that the sector doing best in one year is generally not the sector doing best in the next year. And there are certainly plenty of examples for if a sector has done very bad recently, for example, energy from 2017 to 2020, it does extremely well the next year in 21 and also in 22. So it's actually perhaps a good strategy to invest in what has done badly in the past. It may do better in the future, and perhaps to avoid what has done really recently, it may not do so good in the near future. If you were to follow this sort of a strategy, you might use something like I've demonstrated here, which is using 10-year averages. So if I look on this, the blue line is the percentage of the S&P 500 invested in infotech. In this case, invested in XLK, which follows the tech sector. The red line is a 10-year average of the percentage of the S&P 500 invested in this sector, at least after we have 10 years of data. At the beginning, it's a running average. So if instead of investing in the S&P percent weighting, which would have been close to 20% here approaching 2000, you had invested in the 10-year average down here of only around 12%, then you would have avoided a lot of the bursting of the tech bubble. Similarly, we had a second tech bubble in 2020, and you would have underinvested in this. So this approach may cause you to avoid some of the upside, but would also cause you to avoid a lot of the downside. So it would lower the risk of your portfolio. We can say the same thing in the energy sector. Here is the percentage of the S&P 500 in energy from, again, 1990 until 2021. These are end of the year percentages. And this is the 10-year average of that percent in the energy sector after we have 10 years of data, and again, a rolling average before that. So if instead of investing here in the energy sector of only a little over 2% in 2022, you invested in the 10-year average, you would have had over 6% and would have participated more heavily in the energy sector in 2022 when it did very well. A more stable sort of average sector is the utilities sector, and the utilities sector, well, it went down quite a bit in the 90s. It's been relatively stable since then. The utilities sector has lost money this year, but not nearly as much as tech. So if you had chosen the 10-year average in utilities, you would have been at a little over 3% instead of 2.5%. That extra 3 is largely taken out of tech, so at least you would have lost less money than investing in tech. If we look at this table, this shows all 11 of the GICS sectors. We have in our first column here the 2021 10-year average weighting in each sector. We have the weighting in each sector at the end of 2021, and we have the current weighting in October of 2022. Our approach is to look at each sector and do the 10-year average weighting versus the current weighting. So at the beginning of 2022, we would have significantly underweighted information technology with a weighting of around 22% versus 29% in the S&P 500. Healthcare at 13.8 versus 13.3 is close to equal weight. Consumer discretionary at 11.8 versus 12.5 is slightly underweight. Financials at 14.2 versus 10.7 is significantly overweight. Communication services, which was split out of tech and is basically things like Facebook, at 5.6 versus 10.2 is significantly underweight. Industrials at 9.6 versus 7.8 is overweight. Consumer staples at 8.5 versus 5.9 is overweight. Real estate's about the same at 2.8. And energy at 6.4 versus 2.7 is significantly overweight. Materials 2.9 versus 2.6, close to equal weight. And utilities of 3.1 to 2.5 is slightly overweight. So if we took this approach, we would have significantly underweighted the sectors that did the worst, information technology and communication services, one of which lost around 31%, the other close to 37%. We would have underweighted communication discretionary at least somewhat, which lost 31%, and we would have significantly overweighted energy, which was the only profitable sector this year, making 46%. So overall, using the 10-year average return approach, we would have still lost money in 2022, losing 18%, but the S&P 500 lost close to 23% year to date. So we would have very significantly outperformed the S&P 500. Looking at each year for which we have data, the average sector weighting outperformance of the S&P 500 varies from year to year. We can see here in the early years after the bursting of the tech bubble, this approach significantly outperformed the S&P 500. In recent years, as it outperformed the S&P 500, but there's a few years in here, 1, 2, 3, 4, 5, 6, 7, where it underperformed the S&P 500. We have 23 data points. We made less money than the S&P 500 in 7 of those, so we outperformed the S&P 500 in 16 years. Overall, this is around a 1% outperformance each year. If we had invested $100,000 in 1999 in the S&P 500 at the end of 21, that would have given you roughly $540,000, whereas the 10-year average approach would have given you around $650,000. We're now going to look at a few of these sectors in more detail. On this graph, we have the S&P 500, the 500 largest stocks in the United States in purple here. And then that is split again into the 11 different GICS sectors. One of those, XLU, is shown in blue. The energy sector, XLE, is shown in red, and XLK, the tech sector, is shown in light blue. So we can see that the tech sector is more volatile than the S&P 500. Here is the dot-com bubble, where it burst in 2000 and then lost a very significant amount of money. And then here is the most recent tech 2020 bubble, where it went way up and then way down. The energy sector is also very volatile. You would have made a ton of money in energy going from 2003 up to around 2007, and this dropped just like the housing bubble, and then back up back after that to 14, and then back down, bottoming in 2020 when all the planes were grounded and nobody was buying gas, and then picking back up again in 21 and 22. XLU is the utilities sector, and it is far more stable, and probably far more stable than the S&P 500. It pays a high dividend, it's heavily regulated, it is pretty highly leveraged, but it's largely a sort of bond alternative that will give you a good dividend with at least reasonable stability. If we look at information technology in more detail, we see it's lost around 22%, pretty significantly this year, with the largest losses in software, down here around 28%, and even more so in semiconductors and semiconductor equipment at 33%. The biggest sectors are the 3 listed at the bottom, with those 2 being 2 of the biggest. All these are in the $1 trillion range, so very large, whereas communications equipment and electronic equipment and instruments and components are only in the $100 billion range. We can also split up the information technology sector slightly differently and look at the behavior of each of these industries as a function of size. In general, you will see that the software industry has done worse than the other industries, hardware performing possibly the best, and the nano and micro-sized companies have done even worse than the mega-sized companies, which have not done particularly well. Information technology includes some of the biggest names in the S&P 500, and certainly a lot of names that most people will be familiar with: Apple, Microsoft, NVIDIA, Visa, PayPal, MasterCard, Adobe, Intel, Salesforce, and Cisco being the top 10 holdings, which is around 67% of the total assets in the sector. So it is a highly concentrated sector, just as the S&P 500 itself is highly concentrated in the top 10 stocks. Communication services was largely split out of the IT sector, so it is also largely IT and has been the worst performing sector this year, down 38%. It has the 5 listed industries, with interactive media and services being the largest at close to 2 trillion, and the others in the several hundred billion range. Interactive media, of course, includes companies like Facebook that have not done particularly well this year. The total size is $4 trillion for communication services. And once again, we can split it up based on size, and the mega large companies have done badly, but the smaller companies have done even worse. The biggest company in communication services is, of course, Facebook, followed by Alphabet, the parent of Google, then companies like Netflix, Charter, Comcast, T-Mobile, Walt Disney, even though it still makes a lot of money off its theme parks, AT&T and Verizon, and again, this is a heavily concentrated sector, with the top 10 holdings being 78% of the sector. The energy sector has done far better this year, the best performing sector by far, being up 44.5% year to date. It is mainly oil, gas, and consumable fuels, being 3.4% or $3.4 trillion of the industry's total of around 3.6 trillion. And the other component, energy equipment and services, is relatively quite small at only 200 billion. This is again largely an oil and gas sector. Other energy is quite small. If we look at the companies in the energy sector, there are again a lot of companies you have heard of probably: Exxon, Chevron, ConocoPhillips, etc. And the top 10 holdings are again 77%. So once again, highly concentrated. The smaller companies do not have a particularly large market cap. This graph shows crude oil prices in 2010 dollars from the 1940s until around 2012. The baseline for oil seems to be about $20 a barrel, and it seems reasonably likely that it would stay there if it wasn't for things like wars in the Middle East and government interference. The 70s here is particularly interesting. We have a skyrocketing in the price of oil, particularly during the time period of the Iran-Iraq War and the Iranian Revolution before that. But notice there is both a red line and a black line. The black line is the world price of oil. The red line is the U.S. price of oil. After defaulting on the Bretton Woods Agreement, the gold standard in the early 70s, Richard Nixon imposed price controls. He abandoned most of those within a year, but the price control on oil lasted from the Nixon administration all the way up to the Reagan administration. Ronald Reagan got rid of it finally, and it caused a lot of problems, as most price controls do. So the U.S. price that oil was legally allowed to be set was set by the government, not by the free market, and it was set below the world price range. As a result, well, people in Texas and Oklahoma were upset because they didn't make as much money as they could selling on the open market. And of course, other countries would not sell to the United States. Therefore, there was a shortage of oil in the United States, and occasionally your gas station might run out of gas. Other countries in the world do impose these sort of price controls. Venezuela, for example, when I was there in the 90s, had gas prices way below the world market, but they could do that because they were energy self-sufficient. The United States is not energy self-sufficient. Other countries like Norway, who have tons of oil, actually keep their domestic gas price above the world market price, and they make a ton of money off oil sales. Norway runs a budget surplus every year, and they have a large sovereign wealth fund that makes money for the country, whereas, of course, the U.S. has a major deficit. Norway's sovereign wealth fund pays for things like their socialized medical system. While there is a lot of discussion about renewable energy sources, they are still not a very major source of energy in the world. This graph shows global primary energy consumption by source from the 1800s to today, and of course, most of the consumption is still in gas, coal, and oil. Lower down here, we have traditional biomass, which has stayed relatively stable. Well, of course, these have skyrocketed. And you have some nuclear, and then very tiny portions down at the bottom of wind, solar, and other renewables. So they're really a small fraction of the energy that is consumed in the world. Even countries like Denmark, who make a big deal about having a lot of their electricity production coming from renewables, do not use renewables for heat. They still heat their homes with things like coal, oil, and in some rural areas, burning wood pellets. The last sector we will look at is the utility sector. It's split into 5 industries: electric, gas, independent power, renewable electric producers, multi-utilities, and water. By far the biggest of these is the electric utilities at around $800 billion out of a $1.4 trillion market cap sector, followed by multi-utilities, independent, and water power. And utilities have lost money this year, but not nearly as much as the S&P 500. The utilities sector, again, is heavily regulated. The green area here, over 90%, is the regulated area. This area here is the non-regulated area. So generally, if a utility is worried about making a profit, it will go to the government. It will ask, can I raise the prices of all my consumers? The government normally says yes, after maybe making them go around and demonstrate to their consumers why they need to. So utilities are unlikely to make money. They're pretty stable. They generally don't make a ton of money. And again, they trade sort of like bonds. There are a few weird stories, like with Enron, where a utility can lose money. That was the result of the regulatory system in California at the time. Enron obviously engaged in a lot of accounting fraud, but that was to cover up all of their losses. The losses were due to the California system, where they had a set price, a regulated price for the retail consumption of energy that was being sold, but they let the wholesale price fluctuate. The wholesale price for energy went above the retail price, so the more energy that Enron sold, the more money it lost. Obviously, the incentive was to not sell energy, so Enron tried to sell as little energy as possible, and this resulted then in rolling brownouts and blackouts throughout California, and of course the eventual bankruptcy of Enron. Utility sector is, like all of them, reasonably highly concentrated, with 64% of the sector dominated by the top 10 holdings, which are Next Energy, Duke Energy Southern, Dominican Energy, etc., on this list. As we discussed, utilities are relatively low risk. You can see here, particularly if I look down at the bottom, S&P 500 yields by sector. The utilities sector has a 3.2% dividend. There are higher ones like real estate and energy, but those are relatively volatile sectors, particularly the energy sector. So this sort of trades like a bond. It's considered a relatively safe investment for particularly retired people that might want to stick money into it to live off of during their golden years. And real estate, to some extent, is similar. The information in this video came from a large variety of sources. Many of the graphs that were very useful came from Fidelity. Other ones, of course, Yahoo Finance, Guru Focus has a lot of useful information in it. The sector table came from this site right here. Our World in Data gave us the energy table, and the very excellent information down here at the bottom reference gave us the graph on the history of the U.S. oil prices. I thank you for watching this video.